the easiest customer to win is the one you've already got, and the hardest customer to win is the one you've just lost. So therefore, invest in the customers you've already got, and that's a route to success. I remember when I started the business, I would go and see every single customer face to face. I'd get there, and in 2 minutes, I either felt comfortable or I didn't. If you start asking the questions and you don't feel comfortable, you feel you're not asked enough questions, that's a great reason to walk away.
Hi folks, quick message for me on today's guest. He's the head of Roma Finance. Now Roma is a lender that we've been using for many, many years. In the bridging and development finance space, it can be a little bit scary. We're not FCA regulated, so you will have to do your own due diligence, but these are the guys that we turn to 90% of the time. This year, they've actually secured some really good products for term finance as well, which is the traditional mortgage branding. So not only can they do the front end, but they can do the back end really, really well of every single property journey. So they're full turnkey lifecycle providers. Their taglines are love to lend, and they really want to get to know their investors. So if this is a thing that you need in your lives, I would suggest you go and chat to Roma Finance. You can go directly or via a broker. Speak soon. Let's crack on with the podcast.
Hi everyone. Just before we get going with today's podcast, just a quick announcement that our book is now live on Amazon. If you go and search for Financial Freedom at BDRR, you'll find a book that describes the mindset, strategies, systems that we've put together to deliver over 50 projects in 5 years. We launched it in 2025 and it went to #1 in 3 separate categories on the bestseller list. So hopefully you'll find some real good value out of it. And just one more time, Financial Freedom, BDRR on Amazon.
Yeah, the BDR evolution is changing again.
Well, that's the full title. If you want to be picky. Yeah, go and find it. Hi folks, and welcome back to the Financial Freedom Podcast. Today on the show, we're going to be talking to one of our technical episodes, and it's a technical episode with a really top tier guest, who I'm going to be talking about all things deal making and lending. So a huge welcome to the CEO and founder of Roma Finance, Scott Marshall. Welcome,
Thank you
Scott.
very much indeed. Delighted to be here.
Thanks for coming, man. We appreciate it. So
The biggest non-bank lender, I believe. Is that right?
Yeah.
One of
the biggest.
One of them. Not yet the biggest, but
Right.
one of them.
One of the biggest,
We're on a journey. And
Did you used to work for the biggest?
I did use to work for the biggest.
They won't talk about them.
They're in my sights.
Yeah, just on the corner. So, Scott, obviously this is a little bit about how property investors, developers can structure their deals for success to be able to get lending, which we see is one of the big 3 key risks to any investor's journey. I have to, so I wanted to just lead off by saying we and our clients, I think we've now used 20 to 22 projects.
Something like that.
With Roma Finance, and it's been a successful journey every single time. So whatever you're doing, keep doing it, sir. And that's the reason that we thought you'd be the best person to help us with this. But enough about blowing smoke at Roma's.
No, keep going, please. Please keep going.
Now you've won enough awards already, mate. You don't need me. So I'm going to start off with the same question that we ask everybody, which is it's the Financial Freedom Podcast. Yeah. Can you help us to define what does financial freedom mean to you as a definition of a phrase?
Dead simple. Autonomy over my life. And what I mean by that, and I remember this so clearly, before I'd set up Roma, I think I'd been sacked 4 or 5 times. I'd been made redundant 4 or 5 times, including from a firm that's not too far away from here. Yeah. You know, every time that you get sacked or you get made redundant, you know, it is a moment where you've got to take stock. The last time I got made redundant was credit crunch, obviously from there. And, you know, we just had our 3rd child. We had no money at all. You know, it was a struggle. And I remember saying to my wife that I don't know why, but being made redundant for this 4th or 5th time is the best thing that's ever happened to us. Don't know why, but I just tell you, this is the best thing that ever happened to us. And around about within a week or so, I was chatting to a friend who's done very well. And I say, oh, you know, I'm going to start my own business. I'm definitely going to start my own business. This is the kick that I needed to get going. And she said, well, why would you want to do that? So I said, all I want is to be able to watch my kids in a school concert when they're in a concert without having to ask permission, go on holiday without having to ask permission, start work when I want to start work, finish work when I want to finish work. And work the hours that fit in within my lifestyle. And she was like, you're mad. I said, no. I said, for me, I want autonomy over my life. I don't want somebody else dictating to me what I need, where and when where I should be, and what I should be doing, and how. And so that was money was never the driver for me ever. It was all about freedom, which is why I kind of love the title of this podcast, Financial Freedom Podcast, because Roma was all about freedom for me rather than success. The success was freedom rather than the financial aspect being the success, if that makes sense.
Yeah, of course.
And that's been everything that drives me. And so when I've been recruiting and employing people within Roma, for me, when they're asking, can I do this, can I do that? I just put my fingers in my ears. I'm not, and my team will know that that's how I react, because it's about trust. When you are working for somebody else and they're saying to you, make the time up. I was when in all my previous jobs, doing 10, 12 hours a day, and taking work home with me and what have you. And if someone's saying to me, "Oh, make the time up," I'm like, bugger you. I've actually been putting the extra in. This is, I need a little bit back from you. I want some flexibility.
Yeah.
And so I think that you get the best out of people if you treat them like adults. When you treat people like kids, they behave like kids. When you treat people like adults, they behave like adults.
Yeah.
And so, again, going back to it, I made a vow to myself that when I was employing people at Roma, they would have the same level of freedom that I enjoyed, because that was an important aspect to me of why I set the business up in the first place.
It's a good point, isn't it? Because when you treat people like adults, then you get a reputation of that, and then you actually recruit adults.
Not only that, but people feel empowered to make better decisions because they've got the autonomy over other parts of what's going on. And so give people the rope. The worst that can happen if a decision is made, is done wrong, worst that can happen is that you lose a bit of money.
Yeah.
Okay. No one will get hurt, no one will die, all being well. Okay. And therefore you'll learn so much more, and your team will learn so much more by cocking up, making a mistake, but letting them own it. Because in so many businesses, they say that, shit rolls uphill. If I can use that language, sorry if I can't.
No, you're fine.
Okay,
Yeah.
fine.
You can definitely swear on this podcast. All good.
Thanks.
We've got on holiday.
Right, so good point.
There'd be too much editing otherwise.
Doesn't know what swearing is.
So it tends to roll uphill, doesn't it?
Yeah.
And so, your first thing you say is, well, what's your view? Tim, what do you think? Phil, what's your, and the interesting thing is, if you're not the hero within your business, then actually sometimes people come up with better ideas than you do. And you will learn as the owner of the company from somebody else's ideas. And let's say the idea's wrong. Sometimes, I disagree with it. I might say, well, Phil, you come up with that idea. I wouldn't have done the same thing, but let's run with it. See where it goes. And if it doesn't work, this is what I would have done. Let's try that instead.
Yeah.
Okay, and so it's all around making sure that people feel empowered, because people make better decisions and actually put more in. It's a bit like any relationship, right? A work environment is like any relationship, like a marriage, like any relationship. If you put more into that relationship than you expect to get out, and both sides do that, no one's ever disappointed. Okay, and in so many environments at work, often marriages as well, right? People are putting more in than one's giving, one's taking. But if both sides are giving, okay, then actually, and you're giving more than you expect to receive, no one's ever disappointed. And I think that's how to create a motivated team. I use
a very similar phrase, which is the best way to work is to have two parties who are both but the relationship is a 60% to a 40%. But both parties are trying to be the 60.
Yeah, very similar, exactly the same.
Yeah, so that, and it's funny because we don't have anything on our business, do we?
No, I was just thinking when you're talking about the times and stuff, we've had people that we've brought into the business and they ask us oh, what are my set hours? We're like, why do you keep asking that? We have certain roles, obviously, like lettings as an example, we sort of 10 till 7 or whatever, because you're not really doing viewings at 8 to 10 in the morning or whatever. There's a bit more of a guideline. And obviously Saturday morning is a good time for viewing. So certain things like that. But apart from that, we're like,
but it's a guideline.
It's a guideline. You got a job description. That's it. You need to achieve those goals.
Yeah, when they were doing work in Manchester City Centre, years ago, the traffic is absolute nightmare in town, and our office is obviously in town. And I changed the whole structure of the working day. So I said to people, right, your core hours 10 till 4, okay, but you choose what time you work either side to suit you, to suit your family, to suit your lifestyle. Okay, but the best thing is that the car park isn't big enough for everybody, so we tend to get people.
Yeah, everyone's in at 7:30. Yeah,
there's an exit at 4:00.
Yeah.
But the point is that people have got an element of autonomy and freedom over how they run their lives.
Yeah, yeah,
and that's very important.
Yeah, absolutely. Our biggest problem, what we found when we started doing that, our biggest problem was getting people to switch off. And it was like we lost 1 or 2 people in the business because they couldn't do that. And then when they were exiting, I asked them, why has it come to this?
Yeah.
It wasn't anything to do with anything that we had done. It's everything to do with their ability to manage their time.
Yeah.
But then good leadership or management can look at something and, I don't know, let's use property management example, because I think that's sort of what you're getting at, which is hard to switch off. I think at the time we looked at, and we do use it now, we have like an emergency call out line. Yeah. Because a lot of them, unless it's an emergency, you only need to deal with it the next day, say.
Yeah.
So the emergency line's there. If it is emergency, that the person will get the call they have to deal with it. But all of the other 90% of the things raised can just wait till the next day. Yeah. So sometimes you can help with those sort of things.
It wasn't even that. It wasn't even that. It wasn't even to do with that. It was more to do with the fact that I'd be getting emails from people at 6, 7 at night. It'd be like, well, it's not even important.
Yeah.
And I say, well, were you working late tonight? Oh, no. Did you start late? No. So, and one of our worst is our finance manager, by the way.
Yeah.
She works far too hard and for far too long hours because she takes an interest in everything. Yeah. Which is great to have. And I tell her off.
The biggest problem from her perspective is that if she's doing everything herself, she will not be able to develop the people underneath her. Okay. And actually, I think that being a boss of a business employing people, every year you should be trying to make yourself redundant.
Yes.
Yeah.
In order for you to be able to work on the business and develop the business.
Yeah.
And then the people within your company can grow and develop their careers. And I find it personally very rewarding, incredibly rewarding, seeing other people develop their careers in something that I started from zero.
Yeah.
Me on my own in my car, can have a deal to where we are. And by the end of this year, we'll have nearly 100 staff.
No, that's good, isn't it?
Did
you intend to go at that?
No. I honestly, I thought I would be, genuinely, I thought I would be a terrible boss. I thought I'd be a terrible leader. I thought that, et cetera, because I've struggled in the past.
Oh, we know some of your staff, Scott, so I'll tell you about them.
Fair enough. But I just trying to build, I'm not a dictator. I'm not, it's a very collaborative approach, and I just try and ensure that people enjoy it.
So at what point in your I want autonomy over my life did playing paddle on a Friday come into it?
The irony is that so the first time I played paddle during the working day, I think was either last week or 2 weeks ago.
Right.
And I can't say, and it's now been 17 years since I started the business. So that was like the first, this is the second time. Okay. I actually almost didn't come because I didn't want you to think that I was, because you have a guilty feeling, don't you? You feel guilty that you're, but on the other side, I often work evenings. I'm working lots of weekends, right? So actually, I started to feel a bit less guilty over playing a paddle game on a Friday afternoon.
Any business owner wants to be seen in a certain light, and that guilt feeling doesn't go away. Yeah. And no matter how much you tell yourself,
and the imposter syndrome as well.
Yeah.
You almost feel like you've got to be the person that's working the hardest. And I think for 17 years or so, I probably have worked the hardest, or I felt that I've worked the hardest. I think it's only been more recently where the business has kind of got to a size where I've thought to myself, actually, do you know what? I am working weekends. I am working evenings. So I need a bit more flexibility in the day.
And there's definitely certain times as the head of the business where there's things that happen outside of the hours you just have to deal with and you're responsible for, which also means other times like a Friday. Just for the people on audio at the moment, do you want to just describe what you're wearing at the moment? Because not everyone's on the video, sorry.
Fortunately people can't see what I'm wearing like below the waist. But I'm wearing a pair of male sports tights, I should say. And a pair of should I stand up?
Are they? No, you're right.
You're right.
And a pair of shorts. So, and that's because I'm prone to injury, and the kind of compression tights actually, I've not, thank God, touch wood, I've not had an injury since I've been wearing these tights, playing paddle.
So, and there'll be a few people who are paddle fans now because it's just exploded, hasn't it? And it's one of those things which is, I think pretty much every time I go and view a commercial property now, someone's looking at it to kind of convert this to a paddle place. But so there'll be people listening to this going, "Oh, Scott plays paddle. I'm gonna play him at paddle." But
with pleasure.
You've got a secret weapon, right? You were all right at
I'm a bit competitive.
You're competitive, but you've got a background in this type of stuff as well, right? So what was your claim to fame?
So I played racket sports. I had a county ranking for table tennis.
Right.
As a young kid, I played for university. In fact, I once played the Hong Kong #1 in the inter-university championships. When I must be like 30 odd years ago, I got schmeissed.
Yeah.
To be fair.
Yeah.
So, but she was a bit better than me.
Well, it's almost a national sport.
Yeah,
it's different.
And it's interesting. Obviously, a lot of Hong Kong people have come to live in the UK. So I was playing club level table tennis until very recently when I took up paddle and pickleball. To be fair, I like pickleball as well. There's a load of Hong Kong people that live in Altrincham near where I live, and Altrincham Grammar School. They've got a table tennis club which is they're kind of established and they run. And so I thought I went for a few of the games. And then I went into the tournament. So I went into the tournament thinking to myself, you know what? I'll do all right. Okay. Some 13, 14, 15-year-old kid.
Yeah.
Again.
Whooped you.
Whooped me. But I think that might have been the quarters or whatever. So, yeah. There's always, you know what? It just shows you there's always someone better than you.
Yeah, there is.
There's always someone better. There's someone better than you and someone harder than you. Someone cleverer than you.
Yeah.
So, yeah.
That was a bigger fish.
Yeah, absolutely.
Right then. So, on to the question. So, obviously, we're looking to add value to our listeners, and I think it would be remiss of us not to focus on the things that matter, if that's okay. So obviously, you've just hit a couple of milestones recently from lending perspective, haven't you? Did you want to mention that?
Yeah, so we've surged past £1 billion worth of lending. The loan book is 300 million. We'll have. I don't know when it's kind of going out, but we're literally in the final stages of completion of a multi-billion-pound facility that will move us into a very different space, sort of longer term lending.
Because it looks to me like you're trying to create the ultimate turnkey service.
We have a very, very simple business, which is that, and I'll describe it to you. So anybody that's using our money to either add value to a property or to get an income from property should be a Roma customer.
Great.
So you think about what you've done.
Yeah.
Okay. Adding value to, you do both, adding value to property, getting an income from property. We want to be with you on that journey of wealth creation for you and your families.
Perfect.
Okay.
That's perfect,
Hence why, we've got the revolving credit facility, which is like a kind of fighting fund that you've got where you've got facilities secured against lowly geared or unencumbered property that you can use that to go and buy property quickly at cheap prices as a cash buyer. Number one. Number two, we've got the dev finance product, which can be used for dev renovations, refurbs, conversions, ground up, obviously. You know that as well.
Of course, yeah.
When the property is wind and watertight, we can move from a dev onto a bridge. And when it is then finished and starts to become income producing, depending on whether it's resi or commercial, we can move you on to longer term buy to let or commercial mortgage. And the idea is that you've created a whole load of equity in a property at that point. And our products are designed that you can release the equity you've created, use that, obviously partly for lifestyle purposes, obviously, but also to go and use that to go and on the next project, rinse and repeat, and continue on your own wealth creation journey. And so what we're trying to do is link your success with our success and align the two.
It's great because it's a full turnkey then, isn't it? It's the start to the end of the last. I don't believe any particular lending party has nailed it for the private sector right now yet.
Not the full end to end anyway.
And when we set up our business, we wanted to offer the turnkey for the other side of it, which is you want to be a cash flow investor and you want to work within the HMO space. We'll find it, we'll build it, we'll manage it. So you can just do what you need to do, which is raise the funds and take the risks technically. Ultimately. So it is great, and I am looking forward to seeing that. It make our lives tons easier, I have to say. If we can just do that. Right, but let's talk about it. So question one is probably the most challenging question because there's no two deals are the same, right? But from a headlines perspective, what makes a deal fundable?
It is all about the borrower. Okay, and the story. So obviously we sit in with part of our products, we sit in the short-term lending space, bridging. And bridging's got a kind of a mixed name. Okay. There are firms in our space that are what I would call property pawnbrokers. They make their money by extracting some or all of the equity that the customer's got in that property to drive their profits. Okay. So going back to the relationships, they're taking equity out of the borrower's property. Okay. And that's how they're making money. everything that we do is around lending to someone who's actually using that to create more equity. It's the complete opposite of how most of this industry works. And so when we are underwriting a case, if you're a property pawnbroker, the other type, you will look at the value of the property and your loan to value. And that will be your first point of call. Whereas what we're saying to ourselves is ultimately, do we trust that person or those people as custodians of our cash to use that money to drive wealth themselves? Do we believe in their ability to do that? Okay. And therefore, the first point of call is we are wanting to know all about you. Tell us about you, your background, what you've done before, what line of work you're in, what line of work you have been in, what gives you the skill set, either that is experienced or transferable from another field, in order to make this project, whatever it is you're doing, successful. Okay. So the first port of call for our underwriting is essentially profiling our borrowers. And just because you've not done it before doesn't mean you can't do it or you won't be successful, but we're trying to take a view on what success looks like. So then we've kind of split that down into what we call the Roma personas. So we know exactly what a Roma borrower looks like. And there are essentially 3 different personas. Okay, we have 3 Roma personas. The first one is blue collar property professional. So somebody who's been on the tools, technically competent to do the job. Okay, backable every day of the week because they know what they're doing. Number 2, somebody who is a white collar property professional. So it might be architect, quantity surveyor, landlord, been in the game a long time. White collar property professional. Generally speaking, they'll have a team of blue collar professionals around them helping to make the project successful. Right? Common sense.
Yep.
The third one, and this is where it gets interesting, where a lot of people don't understand, is the white collar professional from another field that's got transferable skills. And we tend to find that we've got lots of finance directors, pilots, lawyers, accountants, surgeons, people who are effectively successful in another field, people in IT, project management. Again, property development is project management. Okay, because things go wrong, it's how you deal with the stuff, right? So there's areas where there are people that have got transferable skills for property, even though they may not realize it, but want to have a go. Okay, and we'll look at those people and we'll take a view on whether we believe that, and sometimes we'll get it wrong, right? But we believe that that person or those people will be successful in property, and we'll back them. Okay, we've got courage of our convictions. So first one, all about the borrower.
Yep.
The second piece is we want to understand the story. What are you trying to achieve? What are your objectives for this project, for this loan, for this development, whatever it is you're doing? What are you trying to achieve? And do we believe that we can back you on that journey? So number 1, the borrower. Number 2, the story. Only once we are happy with the borrower, we're happy with the story, do we then look at the asset. Okay, so borrower, story, asset in that order. And if you take, let's say the one that we've got on with you at the moment, Albert Mill, right? If you look at that one, look at what it was and look at what it is. If we would have lent on that asset as it was, most firms would have shied away from it. Okay, but we believed in you and we believed in the story, and therefore we knew that that asset, even though it's not mortgageable at the moment, was going to be mortgageable once you had done what you needed to do on it. Okay, so the borrower made sense, the story made sense, the asset didn't make sense, but that borrower was capable. That borrower with that story was capable of making that asset mortgageable at some point in the future. And therefore, the last bit, we would therefore be able to get the exit from our loan. So borrower, story, asset, exit. Whereas the majority of the short-term lending industry, all they're interested in is the asset, and the borrower is almost irrelevant. Okay, and that is the massive difference, the nuanced massive difference between why we as a business have been so successful compared to other firms in our space.
We've seen it.
Yeah, and on that lending point, it's a very good point you raise about the borrower and the story, because, you know, myself and Phil, when we're building our portfolios, we joint venture with people, we raise private investor finance and all those things you got to do to build a portfolio. And ultimately, my mindset shift was sort of like that is, when I was talking to people, when I was trying to raise money, I raised, let's say, millions of pounds of funds with joint venture partners and other partners, and not a single person asked for an analyzer, like a deal analyzer. A, because a lot of the people might not have understood it. B, they just trusted the person. So they're lending to you as the person, even though it might be going to the project and a company.
Yep.
Their interest is in you. So they want to know you and trust you, basically. And that's basically the same sort of principle.
Private equity works in exactly the same way. They'll look at a management team and they'll decide whether a management team, because they won't know the sector necessarily, look at the management team, decide whether the management team are capable of delivering on that plan, yes or no. Okay, they're backing the people. And, we see ourselves as our customer's majority business partner, not because we're taking equity in their project. I think there's a conflict between debt and equity, right? I think you're either in one or you're in the other. You're not in both. So we choose and we want to be in the equity, but we see ourselves as your majority business partner. And the reason why we say that is because your success is linked to our success. Our interests are aligned.
100%.
Okay, and we're providing the majority of the money, and you are the custodians of our cash, and therefore we've got to know, like, and trust you that our money is in safe hands.
Yeah, well, that's otherwise there's a problem, isn't there?
I'm going to add in a question here then.
Of course.
On this topic, so any of our listeners now that say are fairly new in the development space or something like that, and they may fall under those three categories you mentioned, what should they be doing to become trustworthy for someone like your business to lend to, or how can they build that trust with someone like yourselves?
I think there's a few things. I think that the first one is identifying your own weaknesses. People talk a lot about the power team, and I'm not a massive fan of the phrase "you power team."
Yeah.
Okay, it's more like your management team, isn't it?
Team, yeah.
Really. Okay. But we're all good at something and not as good at other things. Okay. So the two of you, I know that obviously we've known each other for some time, but the two of you have got some skills that overlap. You've got some skills that are complementary. You might not have done this in a formal way, but there will be a division of responsibility. There'll be a division of labour, division of skill set between you, and each of you will be playing to your strengths in some way, shape, or form.
Yeah.
So the first thing is identifying the things that you're not good at and bring people in to do the things that you haven't necessarily got the experience to do. So take, for example, let's say a project manager, he doesn't necessarily need his own QS because he's familiar with how projects work and the deviances from a planned project. But he still needs an M&E guy. You still need a structural surveyor. You'll still need an architect. Okay, you'll still need a carpenter, a joiner, a ground worker.
Yeah.
Okay, he'll still need potentially a finance person to look at the numbers. So that team that you're creating, that is one of the ways in which we're looking to say, well, actually, you're, the Roma persona number 3. Okay, so you've not got the property experience or you've not got the technical skills, but actually, what's going to drive the success for you, and can we buy into it?
Yeah, and I think that's a really good point, isn't it? Because we've got a lot of our clients that get referred to Roma either directly with us or through a broker. The first question is who's helping you with this, especially if they're new. Yeah, it's because we're the same. We have a lot of medical professionals and a lot of sort of like engineers and so on, and they're good at what they do. And they're not going to know the difference between a pink board and a blue board, and what size banisters you need. So it's about how do you make sure that everything is captured that can be captured.
And look, you're never going to dot every I and cross every T, because otherwise you'd never do a development and you never do a loan.
Yeah.
Okay. But sometimes, and I'm sure you'll have experienced the same thing. It's sometimes it can be right. Okay, the person's got 80%. First of all, you never let excellent become in the way of good. Number one, because if you do, you don't do anything at all. But number two, you say, well, actually, do you know what? My smell of what's going on is right. And I feel that they are really competent. I remember when I started the business, I would go and see every single customer face to face. Every single one. This was the days when, before smartphones. So I used to have a portable photocopier, right? That was about the size of an A4 piece of paper. I used to take it to meetings with me in the boot of my car. I used to go to someone's house, plug it in, photocopy the original documents. And before I'd go, I'd done a whole piece of work profiling that person and profiling the transaction. I'd go with a clipboard in the olden days, right?
Nice.
Of a load of questions that I'd be asking.
Yeah.
I'd get there and in 2 minutes, I either felt comfortable or I didn't. If I felt comfortable, all the questions just fell away. You'd have a sit down, you have a coffee and a chat. On the other hand, if you start asking the questions and you don't feel comfortable, you feel you're not asked enough questions, that's a great reason to walk away.
Yeah. If you feel like it's hard
Yeah.
And you're not like they're holding back, or you're having to ask too many questions. They're not volunteering information.
So going back, so going back to what, the original question, which is, what makes a deal fundable? First of all, transparency and honesty.
Yeah.
Second of all, and because of the kind of systems that we use, we've got access to so much information about people that are applying to us. And so if you hide something, or inevitably we will find it out. Okay. And, there's always a phrase, isn't there, in business that if you've got bad news, he who brings it up, or he or she who brings it up first wins.
Yeah.
Bring it up first. Tell us what it is, what you're doing to mitigate it. Okay. Or if you need help mitigating it, and we'll try and find a way. And, so I think it's incredibly important to be really transparent about stuff like that.
I think anybody who's trying to make their way in life as well is going to try things, right? And so not everything works.
Yep, it's true.
You'll back people who you shouldn't. Perhaps you look at it again and go, do you know, maybe that wasn't the right project, or wasn't the right person, or whatever.
And we've had that. And part of understanding our customers and the applicants and the borrowers, part of that is if something goes wrong, and look, it does go wrong on a percentage of cases, something goes wrong, can we sit around the table and work it out? Do I think that you're a reasonable person where we can solve it to our mutual benefit? And sometimes you'll get a customer who will be applying to the business, and they're so difficult during the application process. Right? You must have had this with potential tenants, and right? You just think, do you know what?
Even people want to use our services.
Yeah. You just think, do you know what? I don't want to work with you. I don't. This doesn't feel.
You can tell pretty quickly. We have had that with a few potential clients.
Fees? All right, listen, $1 million. $1 million what? I'm just $1 million. That's the fees.
Yeah, you price yourself out of the job, right? You don't want it. Because you only want to work with people that you know, like, and trust.
Yeah. And like you said, what you said before is you want to work with people where you're pushing together to achieve the wealth and collaboratively. So
our first value in our business is no dickheads.
Yeah.
That's it. I've only got 3 values.
What are the two?
Show up and get shit done.
Okay.
And good karma and good vibes.
In other words, using other words, it's exactly the same thing.
Yeah. We're not caught. We don't have to deal with major lenders and walk in the front door, right? So we were looking at a property a couple of days ago, weren't we? And they had all of their corporate values up on the wall, and we were laughing because when we first sat down, I wrote down a bunch of words, right?
That meant nothing, basically.
That meant nothing to anybody. 3 of them were on that wall as well.
It was like professionalism, integrity, and all this.
So I mean, look, integrity is the stuff you do when no one's looking, right?
Exactly.
And I think you can find integrity out quite easily and quite quickly because people will tell you stuff, and you find a whole load of stuff out that they haven't told you, and but getting shit done, and just, life is not a smooth road, and it's not a smooth path. And how you deal with stuff when it goes wrong is more important than how you deal with stuff when it's gone wrong.
That's where your values sit.
And there's times
things go wrong.
There's times when you've got to roll up your sleeves and just literally get shit done and work a bit harder to get something done. And like you said, the problem, especially in property and development, there are things that are going to go wrong. And the more you do it, the more things can come up and you learn to deal with them. Whereas if you've got someone who's just done a few projects and they've never dealt with a problem, they're almost the worst person.
I think the way...
If you've never failed,
and
then you're trying to do big things, you are going to have a rude awakening at some point.
I think that the way that we see it is that, a customer with our business will typically spend 2 weeks with sales. They'll spend somewhere between 2 and 8 weeks, depending on the complexity of the transaction, 2 and 8 weeks with underwriting. And then they'll spend somewhere between 1 and 2 years post-completion. Okay. And therefore, as a business, we are investing in the time post-completion because we want to be committed to that borrower beyond when the case completes, so that they've got a good experience of working with us. Because the easiest customer to win is the one you've already got. And the hardest customer to win is the one you've just lost. So therefore, invest in the customers you've already got. And that's a route to success.
100%.
And if I look at the...
Keeping is the fastest way to grow.
And interesting. So, well, does that mean you do all direct business? And, we do some direct business, but the brokers are an integral part of our business too. And, if we look at the repeat business that we've had over the past 3 years, in some quarters, 70% of the business that we write has been for people that borrowed from us before, and 80% of that, okay, has been from brokers that have put their customer with us before and are putting their customer with us again because they know, like, and trust us.
Do you know one of our brokers that was on our panel as well? They got a complaint the other day. And the complaint was that they only put Roma forwards for development. Tell me more. He said, well, why don't you put anybody else? He said, because I've been doing this for 10 years. Your profile, the development, the deal, the people you're dealing with, the team.
Yeah, it matches.
This is I don't need to put you forward to 5 and get you 5 quotes from 4 people who aren't going to do it. Just put it forward to the right one.
Yeah.
And that's the whole paying someone 10 grand to come out with a hammer and tap in the right place.
Yep.
And then you fix the problem in 5 minutes. And you go, well, I've paid 10 grand for 5 minutes. Like, no,
you paid 10 grand for all the years of experience that I've
and the outcome.
Yeah. And I had to have a conversation with him about why the right company. I wasn't the broker, and why it wasn't the complaint wasn't valid. I was like, anyway. Yeah. So that was the deal that we made Fundable.
Yes.
What about when they fall apart?
So going back to it, it is, I think, what you do when something goes wrong, both sides of the table, right? What you do when something goes wrong, that actually is the defining story of your business. And if I think that we've lent to 5,000 odd different customers over the past X number of years, we've had a dozen. That's it, where stuff has gone seriously wrong.
Yeah.
And typically where it's gone wrong is where the borrower has lied about something.
Right.
Yeah.
Okay. They've lied about something, or they've diverted funds somewhere else.
Oh, right. Yeah, that's not okay.
Okay.
No,
and so, one of the lessons that we have learned is that, we look at, again, part of the profile.
We do that, actually.
So, well, you can't. I mean, interestingly, we were the first, in a space we try and innovate a lot. Okay. So in September 18, we were one of the first businesses that introduced open banking into this space as part of its underwriting process. Open banking is phenomenal. It's more secure for the borrower. Okay. It gives the lender real-time data for a 3-month period. And so you can see, as long as the APIs are still open and working, and that's a separate challenge, but as long as they're open and working, you can see where money is going.
Yeah.
Right? And so from our perspective, when we're funding a project, we want to see where that cash is going. Okay. And on one customer, between drawdown 1 and drawdown 2, they diverted money to another project.
Yeah, that was literally what I was going to say.
Right, yeah, see.
When you said that was because I understood it completely. I'm like, right, they've got a drawdown for development finance, and instead of paying the contractor straight away, they've just transferred it somewhere else. Yeah.
Right.
That's exactly what I thought when you said that. Yeah.
And so
I can see that.
Yeah, and so
see how that happens.
So one of the things that we look at is, we want to see what else you've got going on.
Yeah,
and just because you've got other things going on doesn't mean it's a bad thing necessarily, but we want to not underwrite those projects, but we want to understand those projects, where they're up to, what was the original term, how long has it been going for, what challenges have they got, what was the facility, how much have you drawn, how much is left to draw, are you on track? Because actually what can happen is, and particularly in an inflationary environment, okay, where there's challenges also over planning consents and building regs approvals and practical completion, all that kind of stuff. What happens is that you end up there's a shortfall on this project over here, and so you're trying to divert money from there into there. Okay. And so, understanding what else is going on in the customer's life is a key part of, talking about structuring, it's a key part of structuring a deal. So the original question is, what do you do when something goes wrong? First point of call is we sit around the table and work it all out. And there are, there's different triggers that we've got in the business that will drive certain activities within the business to be able to hopefully act as an early warning signal to us, where we say, right, Tim, we've seen that there's a deviation from what was expected. Is everything okay? Okay. And look, it might be genuine reason, whatever. Kitchen's taking too long to arrive, with a shortage of, can't get hold of the pumps that we need, whatever it is.
I can tell you lots of things that can happen. Yeah. Big utility companies delaying and going into liquidation, and builders becoming unfinancial, and all these sorts of things can happen. Yeah.
Tell us. Yeah. Because we want to help. There are other firms that will want to chop your balls off and use that as an opportunity to default you. Yeah. No, we want to understand. I mean, look, it is our borrowers that pay our wages.
Yeah, of course.
Okay. And therefore, if we can support you in some way, shape, or form to a success moment that's not there, but it's there instead, we want to do it because that's our cash crystallization event. As well, when you are refinancing or when you're selling units, that's when we recover our money too. So
the money's definitely yours at that point, isn't it?
We're aligned. You don't see us as the enemy. See us as part of your business, part of your power team.
The biggest fear in this finance space, which is the short-term borrowing for either bridging or development, is that if I put my hand in the air, they'll just stop lending.
Yeah.
You know, and especially when you're in the middle of a project.
Yeah.
You know, that's like, because you might have something like you said, oh, well, my utility contract has gone bust. I need 30 grand. I don't know where I'm going to get it.
Yep.
But your project might need its next drawdown to pay your builder.
Yep.
And if that gets pulled because of that,
Yep.
you know, you're in a really,
Yep.
you're in much worse a position than you would have been if you'd have just,
Yeah.
you know, found 30 grand from somewhere.
Yeah.
Yeah.
Just gone, actually, this is what needs to happen.
Tell us.
You know, and I need the money, basically.
If and when it happens, you tell us, and you tell us early, okay, we can do something about it.
Yeah.
If you bury your head in the sand, okay, and then you've left it 3, 4, 5 months to tell us,
Yeah.
then we're on the back foot thinking to ourselves, well, we just know about that happened 3 or 4, 5 months ago, right? What else are you not telling us that's happened in 3 or 4, 5 months that we're going to
Right, I can give you a live example of Roma on this, actually, just to reinforce what you're saying. I know we pumped you a little bit, but
keep going.
so one of the projects we were talking about before, so we had a big increase in cost for utility connections.
Yeah, specifically for that.
Specifically for that. So that was about 50 or 60 grand higher than the original quote because of, let's just say, whatever's going on in
Do
the...
you know what's happened there?
No.
Basically, he's told all the utility companies they need to improve their overall infrastructure. They've provided no grants.
And it's just been passed on to...
fined if you don't do it. So it's just been passed on to the developers.
So basically what they said, we can pass it on to the customers. It was worse to pass it on to the general public. So they said, right, we'll just pass on most of it to developments. So the increase was astronomical.
So our pre-Labour price was £3,500 a unit. Our post-Labour price was £8,500 a unit times 10.
50 grand.
50 grand overnight.
Yeah.
Gone.
So anyway, my example is that we had that overspend on our project.
Yeah.
And I think like the Roma team actually rung me up and they're like, oh, we know about this overspend. Do you want to borrow more?
There you go.
Like just to solve, like obviously that I didn't think of it as a solving thing, but obviously they're trying to help solve it. Like they literally just rang me up and said, do you want to borrow it? I'm like, it's okay. We've actually got the funds from our business we can use.
Because I told them.
Yeah.
As you
Tell them, yeah.
Yeah.
I told you.
So we told them, so we were on us. But anyway.
So okay, so whether we volunteered it to you because you told us. The bottom line is we're still on the front foot trying to solve it for you.
Yeah.
Because again, our interests are aligned. Your success moment is our success moment.
So my point is I've had projects in the past where similar things happen, and what the lender's done is instead of that, they've said, right, you need to prove to us you've got the funds tomorrow, otherwise, we need to look at the next drawdown.
Yeah,
that's the usual approach from a lender. Yeah, and I'm like, well, okay, I can evidence I've got it, but like that's just a weird way to like threaten to pull the drawdown. It's like, right, if you pull the drawdown, then we can't pay anyone. So
one of the things that I would say to anybody that is looking, because the due diligence that you do as a customer on your lender is just as important as the due diligence that the lender does on you.
We had one recently for a client who bought at auction.
Yeah.
And this is exactly what you're talking about. He bought at auction, right? So, which is obviously a challenge. So he used finance, short-term finance for this. I'm not going to mention the lender.
You can if it's not Roma.
It's not Roma. It's not Roma. Yeah, I don't want to go into that space. But basically, what's happened is he's bought it as a defective title. Okay. What we didn't know is that the person who's lending the money to buy at auction is the company that's repossessed of the previous party.
So they knew about the issue,
right?
Yeah.
So they've repossessed it. The defective title is their charge. Fast forward to the next part, which is we're moving into a development loan, and it's you guys. You guys are ready. You guys are ready to lend in, let's say, August last year. Ready to lend. Everything's fine. Your underwriter rings us. I'm really sorry. The title charge, the land register's not there. The title charge is still there from not the transaction you've done, the transaction before.
Yeah, the vendor, yeah.
The seller, it hasn't been exited. It's like, right, okay, so what do we need to do? Well, we need to get it all updated. So we go back to...
Your lawyer, presumably.
Yeah, to the client's lawyer.
Yeah.
Who's done this, and he said, oh, well, the problem is that I can't even put the new charge on because the old charge hasn't been satisfied. And it turns out that the old charge is the same lender.
Who's been repaid.
Who's been repaid, but hasn't lifted the charge. And they said, oh, it's the land registry. But our solicitor just checks the requisitions at the land registry. There's no record. There's no escalation.
Mm-hmm.
So it's not like they've gone to say, oh, we need to do it quickly. Mm-hmm. So he's requested that. They've escalated it. Mm. In the meantime, we've gone from August to September to October to November. Still the same problem. Still not resolved. They've served on him.
But they're the
one. That's my face, right? So if you're just listening to this, Scott looks like the most confused man in the world. I rang the MD.
They'd advertised it for auction for repossession.
They put it into auction. So the next guy would have bought it.
So what did you do? So when you phoned the MD, what did he say to you?
He said it's not our fault. It's the land registry. We can't do all of these things because of that.
But they've had the money.
Well, they've had the money originally.
But they've had the redemption because you bought it now.
We bought it with their money. They've lent again.
They lent to you.
Yeah. So they repossessed. They lent again to pay themselves off, basically.
And then they were serving on the basis that you couldn't solve the problem that they created.
Yes, exactly.
So what did he say?
He
So
said,
how did you get it resolved?
But don't need this. There was to get that taken away. There was a settlement figure and things like that. So
yeah, and they charged. Whoa! It was an extortionate amount of money. An extortionate amount of money too.
So when this is finished, I'd love you to tell me who it was.
Yeah, of course I will. Yeah.
off camera, we can tell you definitely. Yeah.
If I look at my space, the space that we operate in, obviously we operate in the unregulated space.
Yes, of course.
But we try our best to behave like a regulated lender operating in an unregulated space.
Yeah.
Okay.
Yeah.
The majority of firms again in our space who are unregulated lenders behave like they're unregulated lenders. And that's a perfect.
Yeah, so it's a perfect example, isn't it? Really?
Rather than sitting down and saying, do you know what, we created this problem. We knew about this problem. Went into auction. We lent to the person that's bought it with that problem. It's our responsibility to fix this rather than to detriment of our customer. He's actually seen it as an opportunity to, again, extract the equity that you've got within that property to drive their profits.
Yeah, and I suppose the end.
Would you ever borrow from them again? Would you ever recommend them to a friend?
No, and bear in mind we're plugged into the property investors.
There you go.
This is what I was going to say is, if
it's going nowhere fast, that company.
if we're doing between us and our clients 20 projects a year for at least the next few years or whatever, they are not going to get any of that business.
There's 100 million lending there, and
Yeah.
we're plugged in and well known.
Yeah.
Within the property investors network.
Yeah.
And anytime anybody asks us who to borrow from, the first thing I do is whatever you do, don't borrow from these people.
Yeah.
Yeah.
Bad news travels faster than good news.
Yeah, of course it does.
Absolutely. Yeah.
Anyway, right.
Wow.
So we're going to talk about creative deal making because
Yeah.
deals aren't always black and white, right? So how do you view it when things aren't perfect? So you mentioned it before, like there might be a planning problem, or there might be some party funds coming in, which is someone's lent the borrower money to help with them with their deal.
Yeah.
How are you being creative in this space?
So you've got to understand as a lender that money comes into projects from all sorts of different angles and different ways, and there's always something that can kind of an exit missile or comes in to knock you off course. Okay, I think that I want to kind of go back a little bit, as part of answering this question. Effectively, within a lending business, you've got to first of all look at who is it that owns the business. What's the background of the owners? Talk about due diligence on a lender, right? Who is it that owns that lending business and what is their background? Okay. So if you are a developer and something goes wrong and a business where the people are former developers or current developers themselves are lending you the money and something goes wrong, what do you think they're going to do? They can step in and finish off themselves. Okay. So your interests and their interests are not aligned. If you are borrowing from hedge fund managers, okay, what do you think is their outcome? What they're looking for is again
Take over an asset, is
as
it?
much money as they can.
Whereas if you look at the background of me and my business and all the challenges that I've had in my career, I'm not interested in. I'm not a developer. I'm not a hedge fund manager. I'm purely an underwriter by background. So I don't have the skill set to go and finish off your project. Okay, so in some ways you've got leverage over me in your projects because I'm relying on you to do a good job. So from your perspective as a customer, and again, going back to doing due diligence on a lending business before you go and borrow from them, whether it's direct or through recommendation from a broker, always as a prospective customer and applicant, always try to understand the people that you are borrowing money from and who owns that business and what they're in it for.
I think the entire property space is people, right?
People, every business is
four
people.
Walls and a roof. It doesn't matter what it looks like.
Yeah. So if we kind of go back to your question, which is, if something's wrong, how do you structure it? I think there's a real difference between different types of underwriting within a business. So if I look at my team, for example, at Roma, okay, we've got certain products which are tick box exercises, okay, so it either fits or it doesn't fit. Okay. And for those roles, you need processors.
Yeah.
Okay. They're not, that's not underwriting.
Yeah.
It's processing that it fits, tick a box, move on. And to be fair, most of the people in the banks and the buy-to-let lenders are that type of person, because the machine, the computer, is deciding whether it fits or it doesn't fit. It's the underwriter that is making the difference between something that fits and something that doesn't fit. It's like slightly nuanced. But but on development finance in particular, you don't want processors, you don't want underwriters, you want rainmakers.
Yeah.
And within
Define rainmaker.
a rainmaker is somebody that something comes along to knock you for six and says, do you know what, Phil? I think we can still make that deal work. Okay. This is what we're thinking of in order to make that transaction work. So it still works for you, it still works for us. What can I get your thoughts?
So trying to solve some problems.
It's problem solving. Yeah.
I've got a really good example. So we had something we were refinancing, and one of the so basically they didn't like, we had a 1 alphabet share for a management company, right? So we had 1 alphabet share, and we had the 1 SIC code. We had the SIC codes that they liked, but they didn't 1 SIC code that they didn't like, a 1 alphabet share. So they said, well, we don't like the layered company structure here, right? So we said, right, well, what we'll do is we'll remove the 1 SIC code and remove the 1 alphabet share. It's not really material to what we're doing anyway. And then we'll come back. So we did that, and then we came back. And then another underwriter of the same company went, I can see they now changed the business to meet our criteria. I don't like that. I'm going to refuse it.
Because it wasn't done before.
So for anybody who's just listening, Scott's face is like, looks very confused. But that's tick box.
So the person hasn't changed. The property hasn't changed.
No.
The security hasn't changed.
And you've actually tried to solve their issue. That they're then criticising you for having solved their issue. It's a bit like the other example where you've got the lender that's lent.
Yeah, I'll show you the message that we got from the broker. The broker was just like,
it's the
most bizarre thing. Which
thank God, that's why we've got a business. Long may it continue.
Yeah, if you're thinking about, like, because some people say to me like, oh well, I've been offered X amount rate, and I'm like, yeah, but who is it? You know what I mean? It's like, it's not worth an extra 0.2% a month.
It isn't.
To work with these companies, it's just not worth it. I can't, and it's difficult if you're new for me to sat here to tell you this.
Do you know? So I say this. I think I told you this story before we started this. You know, when we got our first funding line 10 years ago from an institution, the head of the MD of that division walked in, and I said, I don't understand why you are giving us this funding line. So because you're lending to us at base plus X, and we're lending out at base plus Z. Okay, why don't you just come into the market at base plus Y and you'll clean up? He says to me, well, because you're the expert underwriting team that we don't have. Oh, right, okay, fantastic, I'll take that. And we went off and we did the deal. About 6-9 months later, we're growing, okay, and they're lending us the money to come, grow our business. Great, and we're looking to recruit. We go out to market to recruit. Okay, we get a load of applications for people who are being made redundant from that organisation. Okay, because they're saying they don't need that skill set. So we went and recruited them, and they are still 10 years later or 9 years later working in our business and doing great. And they come in and they like, it was like, for them, because you're in a straitjacket, you bright, intelligent person, you're in a straitjacket, you come into a business like ours, all of a sudden you actually feel empowered to make sensible decisions.
And you could have phrased that differently, which is, you got the underwriters and we don't want. That's slightly different because, but that's fundamental level understanding who you are, which I think is very clever as well, because if he can make X without the pain of Y.
True.
He might have been beyond that point in his career of not wanting the stress, the hassle of all of these people.
Yeah, good point.
And just the security of somebody who does want that at that point. Because I think when you're at different points in your life as well, I think you take different views on decisions.
Agreed.
On what profit versus hassle.
Yeah, agreed.
Right. Cool. All right. So good answer. So exit strategies. The reality of an exit strategy. What does good look like?
Multiple exit strategies.
Okay.
Including contingencies.
Okay.
So which is this is what I'm wanting to do.
Yeah.
This is where I'm trying to get to. This is how I'm going to get there. But if that doesn't work, then I can do this instead. I can do that instead. I can do this instead. I can do that instead.
Yeah.
Okay. And again, going back to assessing the borrower. And the story. So borrower, story, asset, exit. Okay. All of it the story of the borrower is how are you mitigating your downsides and your risks on this project. And it's the more exit strategies there are, the more comfortable we feel. The other thing that can drive a lot of that is, first of all, making sure that the project that you are creating, if it is a development or conversion, whatever, the project that you're doing, the end product, whatever that is, the end product is going to a market that's liquid. Okay, so you think about Manchester, for example. You wouldn't put a poke and pole kitchen into a house in Moston, okay, but you wouldn't put an MDF kitchen into a house in Mobley. Okay, so it's making sure that the end product is right for the market it's going into. And equally with buy-to-lets, if you're doing buy-to-lets, you're going to retain them, that's going to get quite a lot of hammer. Okay, so you make sure it's right for the market. So take advice. If you're going to rent them out, you're going to retain them, then understand what it is people are looking for when they're renting property in that area. Is it a liquid market? Is it near schools, hospitals, universities, on bus routes, good transport links? If it's in the middle of nowhere, okay, and the footfall's poor, it probably isn't going to rent very well and easily. But where that might, and again, the holiday home market has changed a lot over the past years and continues to change, but it might be good for tourists. It's really, we want to make sure that your market and are creating a product that's fit for that market and will be liquid in that market, so that you get churn quickly on that project, and then we can rinse and repeat with you on your next one.
I suppose a good point to discuss there when you talk about multiple exits. So if you think a development, generally, if it's residential, you're either going to keep it or sell it. It's just to simplify it.
Yep.
So maybe a good way to look at it is like, if I'm going to sell it, it's this. If I can't sell it, market changes, there's a dip, whatever. If I refinance it, it's then this product with this user. And how good is that going to be? Because if one of them's going to struggle, that adds the risk, doesn't it? Because you're then losing out on that multiple exit scenario.
Yeah, absolutely. Quite right.
And it's you're right in terms of it's the right horse or the right course at the same time, and we've seen it. We've actually got one of our clients who's having a bit of a problem at the moment because their exit was too niche. In another project, they're doing one with us and with you, actually. They're doing both those things, and that's going swimmingly well.
Yeah.
They have another project that they had basically, I'm not going to name it was basically a social provider who said they wanted something. They wanted X, Y, and Z for their property because they're dictating what they wanted. And it's in an area where if they did it to that level and standard, it has to be for that because nobody else is going to rent in that area at the required price point. So it has to be for that.
And the specification.
Of requirement. So it's not in that area, but you need to do it at a much lower spec for that area, and you wouldn't probably put that type of property in as well. Development done, they pulled out.
No signed contract.
And that's also the challenge. Some of these providers as well, they won't commit until the final finish in a way.
They call it the golden brick leasing, don't they? Where you put the final build control sign off, and then you get
then they get the lease.
Into the lease.
So you're almost at risk all the way through that process until that lease is in place.
It's why we really like the private sector, because as long as we know that there's a density of a population, of the types of profile of people that we can target, we would back ourselves to be the best at the competing in that space, in that area.
So a good way to look at it, and we've talked about it, is if it's a project where it works well in the private sector, but it might get an uplift with something else like a lease or whatever. That's a good way to look at it. Because you've got the multiple exits to that point, don't you?
Yeah. It's more of a benefit if you can.
Yeah.
Than
benefit rather than a necessity.
Yeah, it's tough that though, isn't it? It's a tough lesson to learn. I mean, don't get me wrong, it will rent out, but it won't be at the level. It will refinance it, but it won't be at the level.
Yeah.
So it's just a big chunk of extra capital that you didn't need to spend. And that's all. That's it's not insurmountable. The world's not on fire.
I always say, has anybody been hurt? Has anyone died?
No.
You've lost a bit of money.
Yeah.
We all go through times where sometimes we do better and sometimes we do worse, and that's just life. We'll never do that again. He might mitigate it in some way, shape, or form.
What a learning.
Next one.
Yeah.
You could pay more than they would lose in that project for a degree that wouldn't teach you as much as that project.
You learn more when something goes wrong
100%.
than when it goes right.
Absolutely. Yeah.
Yeah. Cool. So final question. We're in a weird market right now. It's a bit of an up and down space. So what deals are lenders actively backing? Because obviously pencils get sharpened, right? Whenever big orange blokes throw missiles at people, right? What should somebody be looking to do right here, right now, to be A, lendable, and B, successful?
It's like any business. If you buy well, you can sell well. And every business is all about the buying. And in more volatile times, you actually create more opportunities, okay? Because there's less competition to buy, and therefore you can negotiate a better deal. So volatility leads to opportunity, okay, don't knock it. And in the current climate where things are tougher, okay, there is more stress and distress around, this is where you should be your most active on acquisitions. Then you say, well, what sort of things should I be buying? Okay, what sorts of things should I be doing? And I think it's all around, at this moment in time, simplicity. The more complex your project, the more risk it is of it going wrong, and the longer it's taking, and the more difficult it's going to be, and the more challenging your relationship with your funder or your ability to sell or exit or whatever. I think just keep it simple, stupid in the current climate. And so there's two things.
Can you give me
examples?
You see as complex and one
Yeah,
simple?
with pleasure. So I think that, and I know you have just done one, okay, but a barn conversion, for example, it wasn't quite a barn, yours, okay, but a barn conversion, okay, now is more complex than a ground up development where you've got a normal type of soil. It is.
Okay.
A development, a normal simple development is more complex than a doer-upper, fix and a flip.
Yeah.
A fix and a flip, okay, is more complicated than a below market value purchase. You know, and I know it's always been the case, right? But then you're saying to yourself, well, on the levels of complexity, how much better does my purchase price need to be in order to make that deal stack? Because the risks are so much greater, the more cost involved in the project and the longer it's going to take. Because I can't tell you where we're going to be in 12 months' time as a country. I wouldn't have thought we'd be where we are today 12 months ago. So I certainly don't know where we're going to be in 12 months' time. And therefore, if you're going to do a more complex project, and they're fine, we'll still back them, you've got to be building in more time, building in more complexity, building in more cost, and buying as best you possibly can. And don't think to yourself that just because the numbers work on a spreadsheet and you've done it before, it's going to be the same again.
Yeah, so we're pricing extra margins at the moment on, and if we're looking at this more complex, we're at the 30% development margin rather than the 20 to 25, which in Leah is more comfortable than we've done.
Yeah, I think the key thing for that is that with the complexity to a certain extent comes the opportunity.
100%.
Because like you said, if, you know, there's deals to be made there in those sort of things, so they're more complex. So there's opportunities, but on the flip side, it needs to be a really good deal in a way, because if you're getting tight in the numbers, like you said, if your margins, you've underestimated and your margins are relatively tight and your offer price is a bit higher than it should be, then that can get squeezed quite quickly. Whereas if you're looking at something at that 30% margin, even things go really wrong, you're squeezing down to 20% margin instead of zero type thing.
You can say you do your best business in a counter-cyclical environment. You know, and we are absolutely in a counter-cyclical environment. And now is the time to buy.
And it's the coil spring effect as well. So if you're building these margins in on today's price world, you know, and you've got that extra margin now, by the time you're coming out the other end, you know, all of that pent up need and want, and you know, static prices and all that stuff. Once it's released, that equity growth is much faster in a shorter space of time.
Yeah, it's interesting. If I look at house prices and I look at what's happened to house prices over the past 5 years, and then you build in inflation, okay, so you kind of adjust house prices. You can read in the press that house prices have gone up 0.5%, 1%, whatever, okay, building in inflation. And since 2020, house prices have actually come down 17% if you include RPI, 12% if you look at CPI.
Right.
Okay, they've actually come down. And the reason why we've not had it, there's a whole load of reasons why we've not had it.
For the simple people amongst us,
okay.
Do you want to explain RPI and CPI for a second?
Yeah, it depends what to say. RPI is a measure of price increases, basically inflation, and different things are included, making it simple, different things are included in RPI versus CPI.
So CPI is the consumer price index, which is generally a basket of goods that you'd typically buy week to week. So I did a lot of economics at university and stuff like that. So, and then RPI includes, what does it actually stand for?
Fuel, I think.
Could you share some of those economics with my wife?
I try to quite regularly. Yeah, but RPI includes, I think, other things like, say, rent and utilities, sort of things like that are holistic in the environment, but they're not like an apple at the supermarket and stuff like that. Things like,
And interestingly, a lot of people want their wages linked to RPI, and a lot of businesses want to link their staff's wages to CPI. It's just the way that
CPI is a good link to RPI, because if things in the RPI are going up, that will affect the CPI. But like you said,
the bottom line is that house prices have come down,
agreed,
and wages have gone up since affordability. So again, all sorts of other reasons. Banks are better; they've got a lot more capital than they used to have. Pre-credit crunch, affordability tests are much better than they were 15 years ago. Weighted average loan to values across the mainstream lenders are below 45%, so they can build in wiggle room to support their customers going through a more difficult period, which is why repossessions are down. There's all sorts of reasons, but the bottom line is that house prices have dropped over the past few years. And so buying better now, when you're looking at your comparables as to what your thing's going to be worth, right, you've got to take that into account.
Yeah, you raise a really good point, because the supply and demand factors in the economy haven't changed. In fact, the supply is probably reduced, which usually means prices should be going up. But because of everything that's happening in the economy with, say, inflation and interest rates and cost of living, et cetera, adjusted for inflation, it's gone down, which means that there's potentially some good growth.
It's the direct reason why building a social house in Salford is more expensive than buying a terraced house in Salford.
Yeah.
And that's because of the RPI.
The cost to do it,
is outstripped the house prices. Because the house prices haven't risen, and that's what people can't understand. Why we're not building more houses? It costs more to build it than it's worth at the end at the moment.
In lots of places.
Yeah, which is great for people who do refurbishment, by the way. Long may it continue. And we don't want it to go.
If you buy in the areas where the cost of the property is less than the build, what does that tell you?
Exactly.
It's going to go up. The value's going to go up.
It's one of the core principles why there's so many sites that might have planning, might have allocation of thing, but don't get built, because the price at the end is less than the cost of doing it.
100%.
Lovely. Right. That was awesome. Thanks very much. So I think that's everything we need. That's everything that I'm sure we could talk about adding value, and you could add a lot of value to people. I hope people will take a lot of value from that. So we always give you the opportunity to ask us a question. So you've prepared a couple of questions. Do you want to go right ahead?
Yeah. So Phil, you've seen so many investors come and go in this market over the years. What's the single most underrated skill that separates the ones who last from the ones that burn out?
Do you know, it's a good question. So I also run the North Manchester branch for the for the Property Investors Network, which is Simon Zucchi and his crew. So I see a lot of people coming and going. And it's interesting that you say I see a lot of investors come and burn out. I don't think you're an investor till you've invested, right? I think it's a loosely used term for people who are looking to become investors. So what I will say is the number one skill is resilience, and resilience is all you need to become a really successful property investor. Now, resilience, in my opinion, comes in more than one part. So the resilience is, the strategy that's going to make you money, and you don't deviate, because there's too many things to do, right? Do the thing that's going to make you money and stick to it. The second part of resilience is get up every single day and do the same thing. Do it again tomorrow. Repeat. And it's boring and it's frustrating, but do it. And the third part of resilience is know is your best friend. Get comfortable being uncomfortable with the word no.
Agree with all of those things.
And if you can be the person who's nailed their strategy, the person who's willing to do things on repeat without deviation, and be the person who's looking for no's, because no's is the best yes you'll ever have, is the yes on the back of a no, then you're going to be successful. And the thing I see is the failure is in the first part, not having a strategy, the right strategy, because that then builds, if you've got too many things you're trying to do, what then happens is the middle bit, which is doing the stuff on repeat. You're not repeating anything. And then the third thing is you're not getting any no's because
Yep.
you're not doing the first two.
Yep.
So it starts at that very, very front end. So why people burn out, in my opinion, is, and I see it, they stand up, they give them 20 seconds pitch, and I see it every single time and say, oh, I'm a property sourcer. I'm just getting into property and I'm interested in, right? The next 20 seconds is filled with the most amount of property acronyms you've ever heard. PLOs, EPs, exchange delayed completions, BRRs, below market value, HMOs, essays. I'm interested in all these things. Come and talk to me, right? And I'm like, well, that's great that you've come to network. That's a really good starter point to build your resilience. What you now need to do is absolutely nail this down. There's a good book actually. There's a good book about how to do this.
You might be able to see it on the camera right now.
Called Financial Freedom, the BDRR method. So
you create your own methodology. Sounds like a good way to do it as well. But anyway,
you can use people that have done it before, right? So, but that is, to me, is what is the skill.
I love the things you've just said. The first one, doing the same thing day out, building habits. That's number one. Number two, learn to say no. The most valuable thing that you've got is your time. Use it wisely. Okay. The third thing, which I think is absolutely crucial, is if you have got a strategy, stick to it.
Yeah.
And if I think relate that back to my business, around about 5 years ago, when I was developing this customer for life strategy, where I wanted to be able to provide my customer with a toolkit that takes them on that journey, that was the whole thing I wanted to do. Somebody said to me, "Don't do that." It was very successful in the industry. Don't do that. Actually, you want to be deep and narrow and very good at one thing. And I said, no. So this is what my strategy is. And this is, I think, will stand the test of time to be able to provide a solution to customers. It's what we really want to do. So they can de-risk their, okay.
But you are deep and narrow.
In what way?
Because it's the life cycle of the person.
Yeah, correct. But I was pursuing that as a strategy rather than just being very good at bridging or just being very right. And that was, and I felt that our strategy was the right thing to do. So you're right. I did not deviate because I felt that was the right thing for the business. So I completely resonate with all those three things that you've said. Thank you.
Yeah. 100%.
Now, one for you, Tim.
Excellent. Yeah. What do you got?
So you're brilliant at spotting opportunities that other people overlook. What is the most unconventional deal or strategy that you've seen actually work in the real world?
Wow. So I'm going to put this back another way, maybe, because I look at the simplicity of the deal making, if that makes sense. Which kind of relates back to what you're saying it's being consistent at doing the same sort of thing, but simplify and do it well.
Keep it simple, stupid.
Yeah, really keep it simple. But also, I think this might go back to a little bit what you said. There's a lot of new investors, and they get the strategy wrong, or they're not looking at the right thing. They're trying to fit, what's the term, a square peg in a round hole type thing. Or you ask them, like, what are you doing? They're like, I'm looking for PLOs, like purchase lease options. Like, well, yeah, that's a contract form.
Like, can't live in a PLO.
You can't live in a PLO. So, right. Okay. So it doesn't make any sense. So if the people know, they're right, look, I'm just looking for things that will convert to HMO as an example. And then the creative things, can get brought in depending on the property, the deal, the seller, and all those sort of things. So you could use a purchase lease option if the seller doesn't need the money quickly, but they want some money every month while you're doing a planning application example. So that's where it gets creative. So the strategy stays the same. It's like, I'm just going to do HMOs. They got 5 HMOs. That's it. And I'm going to convert, or I'm going to add value to them, whatever. And then the creativity you can bring in around it on the circumstance to enhance the deal, find a good deal, and fund it in the right way, and all those sort of things. So I think it's keep it simple, but have a good toolkit of creativity that you can use around yourself to get the right deals and structure it the right way.
The question is always, does the seller have a problem selling?
Yeah.
So if the answer is no, then it's going to sell on the
Well, that's what
market.
we learned, wasn't it, from Pin and Simon Zucci, is like, is the seller motivated? Yes or no? No, just count it.
If you think about some of the deals we've done, I mean, one of the deals that you did, you had all of the problems we talked about earlier about people going bump and stuff, but the deal you did was funded by the seller.
Yeah, it was under a vendor finance. Because,
yes, the seller gave you the money to buy his property, right?
Amazing.
Yeah. What a good deal.
Yeah.
So yeah.
But it could work because the circumstances existed for that.
Yeah.
I love the idea of keep it simple, stupid.
Yeah.
One of my mentors once said to me, if you can't explain it in one sentence, you don't understand it.
Yeah. Well, if I asked you, you gave it really, really, really well. So which is whom do you serve, you would be able to tell me in probably about
My borrowers pay my wages.
Yeah. So we say it's people are looking to achieve and maintain financial freedom.
So basically, in our portfolios, we used to look for HMOs for working professionals to add value.
Yep.
And now we've still got some of them, but we're mainly just looking for things that would convert to buy-to-lets, blocks of flats, stuff like that for, families or young couples and stuff like that, or people that suit this. That's it.
We say working professionals.
Yeah.
For our properties, we say working professionals, whether you're in the initial transitional part of your life, whether or not you're in your early start of your...
But you know what, so going back to, I know what a Roma persona looks like.
Yeah.
You know what one of your customers looks like.
Yeah.
Okay, you've defined it, you know it, and that'll be some trial and error over the years, but you know the market you're targeting.
Yeah.
And that's really key to success in business.
Yeah. Well, we've got three customers ultimately, haven't we? We've got the customer who wants to help them build their portfolio. These are the people that we bring to you guys.
Yep.
We've got the customer who we serve at the end. So that's the person who lives in our properties. And we've got the customer who sells us the properties.
Yeah.
You know, that's the three sales processes that we have.
Yeah.
Somebody who's got a problem selling, somebody who's a working professional, and somebody who's looking to achieve and maintain financial freedom. And if you can say it that simply, I think you've got your strategy nailed, really.
Yeah.
I think that's really hard for people to do.
If you can't explain it, you don't understand it.
Yeah.
And you do.
Well, exactly. Yeah, exactly.
Yeah. And some people, they might just go, right, I'm a cash buyer. Every offer I do, it's just, I'm going to complete quickly. But some people, that's not the solution they're looking for.
Yeah.
But some people it is.
Yeah.
So just look at the different options you got in the toolkits available.
Agreed.
Yeah.
Lovely. All right. And so that brings us towards the end. I'm conscious we've not even mentioned some of the cool things that you do. So
Property elevator.
property elevator.
Yeah, that's good fun.
Yeah. So property elevator is available on Sky.
It was on Sky. It's now on Amazon Prime.
Amazon Prime.
Yep.
Lovely. So it was on Sky Arts, I think, and then it's on Amazon Prime.
Yeah, correct.
So cool. So Sky Elevator, and you're on there with a few people that we know. Guest of the show.
Yeah. Guest of the show. John Howard, Ranjan Bhattacharya.
Yeah.
Nicholas Warwick, Hayley Andrews.
Haley's coming on as well soon.
Okay, Rachel Knight, Liv Cook. I mean, honestly, all of them. You can learn a lot from these successful people. They're brilliant.
Is Nick the Aussie?
No, the Aussie is Paul. What's his name? You've put me on the spot here.
Oh no.
This is embarrassing.
Paulie Aussie.
We need an Aussie on the show.
Paulie Aussie.
Can we get Aussie on? Can we get an Aussie on this show?
He's a very, very, very bright guy.
Yeah.
Really bright guy, and straight as a dart, like him. Good guy.
Yeah.
Good stuff.
Yeah, nice.
So, how should people get in touch with you? Is it
romafinance.co.uk 0161 817 7480.
Love that.
Let me say it again: 0161 817 7480.
Lovely.
romafinance.co.uk. Enquiries at romafinance.co.uk.
Perfect. Scott, it's been a real pleasure. Thank you so much. Good luck with your paddled match.
Thank you.
And just thank you very much once again for joining us on the Financial Freedom Podcast. Don't forget to like, subscribe, and or turn your notifications on so you know when the next show is going live. And that's it from us. So we will catch you on the next one. Bye for now.
Bye for now. Until the next one.
Thank you.
Thank you once again for joining us on the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. If you want to get in touch with us about today's podcast or any of the learning topics that we've gone through today, you can email us at podcast@invest-proc.co.uk or get in touch with us with whichever your social media platform of choice is. If you think you would add value to us as a guest on this podcast, you can please get in touch and let us know what you would be able to talk to us about. Other than that, we wish you well on your financial freedom journeys. And once again, thank you for joining us, and we'll see you on the next one.